All right, everybody. When I think about the world of things that excite me, it's MSRs. And it is these three guys right here. So put your hands together for the new sheriff of MSRs and MCT, Bill Shirreffs. That was as exciting as it was going to get. I'm just going to forewarn you now.
Thanks, Chris. First of all, thanks to all of you for coming back to the room for the MSR session. You know, we appreciate it. There are a couple of things that I want to clarify before we get started. Curtis actually referenced myself and Azad at the beginning, responsible for driving certain things. And I learned early on in my career that you can't do it alone. And without the entire MCT team and without our MSR services group, nothing gets done. And we've got, you know, Natalie and Gracie here and others from the MSR team. I want to thank them for all that they do. And then I honestly don't know why Paul Yarbrough continues to act like we have anything in common. You know, I think I might have lost, you know, my hair years ago. It's certainly stress related, but I've been married to the same woman for over 32 years, so I think she's probably doing something right. But anyway, so welcome back again. Appreciate you all being here for the MSR Insights session. We also appreciate having MSR in a prominent position on the agenda this year. It's an opportunity for us, and it's a privilege for us to be in such a prominent position on the exchange agenda this year. I think it's fair to say that it's been quite some time since MSR has been this interesting. I'm not going to say that I'm going to make it exciting, but certainly an interesting time for MSR. The pandemic created some dramatic shifts in the market that obviously occurred in early 2020, and that point in time, you can't really fully appreciate where we are right now with MSR without acknowledging the history. That event in early 2020 is continuing to have an effect on the MSR space. So understanding that and acknowledging that is certainly important. Now, whether or not your company actually services loans, you felt the effects in early 2020. Really, it happened overnight. You'll certainly be interested in some of the things that we have to talk about this morning. So what we'll get into during this session is, first of all, how we got here. Secondly, David will do a deep dive into current market trends. And then Azad will talk about why it is so critical, essential, to actually actively manage your MSR portfolio. And now you need to think about it as an MSR asset. It's an asset on the balance sheet, so it's got to be actively managed, and that's a word that I'll emphasize. It's not just, let it flow, let's see how it goes. There are risks that are prevalent that you need to make certain that you're monitoring, and we can certainly help with that. So I'm Bill Shirreffs, head of MSR Services and Sales Operations with MCT, and joining me are two gentlemen with each with over 30 years of experience in both the mortgage space and the servicing space. First of all, David Burruss is our Director of Sales for the MSR Group. David's got broad experience, including from Freddie Mac and PHH and the sub-servicing side. So, Curtis talked about me and Azad being responsible for driving the growth. And I'll tell you that David joined us about 2.5 years ago, and he was really the impetus behind the initial growth that we experienced and continues to be responsible for that. So, David will be talking about current market trends. And then following David, we'll have Azad Rafat. Azad joined us about 5 months ago from ComputerShare, brings a wealth of experience. He has done valuations on thousands of portfolios, actually managed large and small portfolios, and knows the MSR business like no other. And he's more passionate about MSR than anybody that I've ever met, and he's very much like like our friend here, Chris Anderson. A lot of energy, and he's pushing us to get better. So we're happy to have both of these gentlemen on the team. So with that, let's. So as I mentioned, the pandemic created a shift in the market that really lingers on today, and I'll actually get to the first slide here. Servicing buyers backed away and severely discounted the servicing asset in early 2020, caused by a number of uncertainties. Uncertainties around cash advance responsibilities, and depending on the remittance cycle. For those of you that don't issue MBS for Fannie Mae, that's scheduled. With Freddie Mac, it's scheduled actual, but there are cash advance responsibilities that whether or not you receive the funds from the borrower, the servicer is actually responsible for forwarding those funds, advancing those funds. So that was one of the most significant uncertainties that servicing buyers were concerned about in early 2020. They were also concerned about the potential increase in foreclosures, increase in delinquencies, and then the forbearance plans. We didn't really know how long they would last. We didn't know how forgiving they would be. We didn't really even know if the federal government was going to provide some support to servicers. So at that point in time, the servicing buyers were like, there's just too many unknowns here. I'm out. So during that point in time, I think what it really did was highlight the importance of having options and being nimble enough to pivot based on market conditions, based on where the opportunities are. So when servicing buyers backed away, you all had to ask yourself, what sort of options do I have? If I only have a released execution available, that was your only option. So again, it's another one of those things that MCT talks a lot about as far as maximizing your options available in the marketplace, not through only BAM, but other executions. We talk about leveraging a conservative yet proven and time-tested hedging strategy, but also leveraging an aggressive execution strategy. And that includes the MSR asset. That can't be ignored. And so to achieve that effectively, all those options are necessary, and you've got to include the MSR asset. Originators without the flexibility to retain were forced to accept the levels that the market was offering. And you all remember that SRP levels went to 0 in early 2020, and in some cases actually went below 0. So despite understanding that the true fair value of those assets was greater than 0, you had no options. So you took direct hits to your margins, direct hits to your bottom line, direct hits to overall profitability. If you've joined our webinars over the last few months, you've probably seen this slide already in the past. We continue to track the activity. This graph basically illustrates the MCT clients that are approved with the agencies. So you can see I know it's difficult to see, but I'll explain it to you. The left-hand side of the screen, you can see at the top there 80%. That represents sellers approved with the agencies that are actually selling on a released basis. So despite having the ability to retain, this shows you that the vast majority of sellers actually executed on a released basis prior to March of 2020. And you can see how that number plummeted literally overnight because of the servicing buyers backing away. And it went to all the way down below 40%. You can see since the early part of 2020, it's been hovering around 60-40, 50-50. You might have predicted that behavior would go back to the previous levels. Once the SRP pricing came back, that the sellers would go back to executing on a release basis. And what we've experienced and witnessed, and the graph illustrates, is that trend, that expected trend, actually has not happened. Many servicers have decided that here's an asset that's of value to me, and therefore I'm going to continue to retain that business. And in a lot of cases, they're being selective about what they're keeping versus selling. Companies are now realizing that the servicing asset has value to the balance sheet, value to the bottom line, and it's a predictable, reliable income stream, cash flow for the company. But again, we're running at about 50-50 currently. Will we get back to 80-20 at some point in the future? As the market normalizes, I would imagine that we probably will. But again, servicing buyers are understanding the value of that portfolio to their bottom line now and continuing to build their portfolios. So David will get into a lot more detail on some of the market trends, but I just wanted to touch on a few. On portfolio growth, MCT, we actually performed a record number of valuations this year for our clients. We've been tracking these clients over the last 2-3 years, and we have witnessed exponential portfolio growth. Portfolios that were running pretty stable for several years, suddenly over the last 12 to 24 months have spiked. And a portfolio that might have been $400 million a couple of years ago is now $1.5 billion. We've got some that were $4 billion two years ago, we're now $15 billion. We've got one that went from $5 billion to $75 billion. So you can see that a lot of these entities that viewed the portfolio as maybe less strategic are viewing it more as an asset now that has to be actively managed. Cross-hedge. So you're all experiencing this right now with interest rates climbing. You've got price competition, margin compression. The revenue off the production side of the business is declining. While that's happening with the interest rates climbing as well, there's an inverse relationship between interest rates climbing and the value of MSR portfolios. So portfolios that were originated 12 to 24 months ago, with that revenue declining from the production side, the value of the MSR portfolios is actually climbing. We're seeing that it's peaking right now at around a 5-to-1 multiple, so that's around 120, 125, but a lot of portfolio owners now really appreciate the reliability and the predictability of that revenue, and it is offsetting the loss that they've experienced on the production revenue. It's certainly not a one-to-one relationship, but it is offsetting that lost revenue. Like I said, the asset management, when you go from a $5 billion portfolio to a $75 billion portfolio, when the revenue generated off of that and the cash flow off of that is contributing more than 50% of your all-in, you know that you better start paying attention to that. You know that you have to start actively managing that. Not only the stress testing, the cash flows, prepayment speeds, all of those elements need to be much more closely monitored now, and we can see a lot of our servicers are doing that. And then lastly, Phil talked about this a little bit earlier about the MSR marketplace. That's something that we're going to begin development on this year. We know that it's going to be a very robust bulk market over the next 12 to 15 months. So we want to be prepared for that. There are a lot of inefficiencies, at least on the sell side. As far as the operational aspects after the trade, a lot of inefficiencies there as well, but we'll likely not get involved. We will be looking at standardizing agreements. We'll be looking at doing a better job bringing buyers and sellers together. So we're going to start that development, very, very, very soon. So that's sort of a high level, just setting the stage, how we got here. So with that, I'd like to turn it over to David Burruss, our sales director. Thank you.
Thanks, Bill. I appreciate it. Thank you, Chris. Yeah, what's been interesting is probably, as Bill was highlighting, and of course I'm like Phil here, I've got to get this down to my level. So anyway, here we go. It's a... Sure. Oh, thank you, Bill. Yep. All right. A lot going on up here, let me tell you. So as far as the kind of what's been happening in the marketplace, as Bill spoke earlier, that really the whole event of COVID 2 years ago is really what has set us up for this time that we have for MSR right now. And it's really a very exciting time to be holding a portfolio and looking at what that impact is having on the marketplace. So I think actually it's probably one of the biggest factors going on that people are trying to figure out, because it's not been something they've been used to managing on a daily basis. And just Bill was pointing out the rapid growth in portfolios, there were several different reactions from the marketplace about kind of what's taking place in there now. The trends that we spoke about have really just taken off. So that 5-to-1 level is about where we're at right now in conventional, about 3.5 on the Govy side, and it goes up and down based on the particular time you're hitting the market. But what we're watching, and we'll talk more about this on the next slide, but bulk is really very, very active, and so the buyers continue to come out even with the little ripples that we've had in interest rates as of late and the T-bill moving around. So it's been a very positive thing so far. And then really it's driven kind of three major things for the origination market to deal with that they really haven't looked at that much before. With increased compression, there's been the look at, well, what are my MSR values? And how am I pricing my values in? And do I have the right tools that's going to help me get there? Because in the case where you have generic grids that you're using to create a price, those are really working against you. The loans you want, you're not going to get, and the ones that you really want, you're going to lose those as well too. So we've really, the issue for a necessity for granular MSR pricing has really become key. So we want to make sure and help you with that. There's a lot of different solutions out there now, and certainly we can help provide those. And then as far as portfolio retention, again, as Bill was alluding to, there's been kind of two reactions about having this portfolio. One is that people have figured out that they really are getting a nice cash flow, and it really can help them during times like this not worry about what's really happening on the production side, or give them a more stability to pay expenses. So that's been very, very helpful. But the part that's been challenging has been really trying to figure out, do they want to keep it? And because if you want to enjoy that revenue, you're going to have to manage it. In most cases, people haven't been used to managing it before. And so what will you do about that, and how will you go about it? Will you hire somebody in? Will you look at different other resources in order to accommodate that? So that's really kind of that on the retention side. And then the other side is then just sell it. It's easier just to get rid of it because it's for all the contemplation of what to do and how to do it. It provides instant cash for you, so it's very liquid. Obviously, we move it to the marketplace and then get it done for you. So those are some real interesting parts about really kind of what's impacting the market right now today on that side. So, and then as far as future trends go, we see a couple of things taking place. I know Phil alluded to it earlier, but certainly there's inefficiencies in the way that the bulk market is working. There are two primary issues. One is this, the lack of transparency in terms of the way pricing is working. And then the other part is really the transfer between subservicers. There's this, each subservicer has about 95, 97% of the same data transaction to move a loan back and forth. But the interesting part about that is that the difference is minimal. It's like one wants you to put the color of the house, the other wants you to put what kind of car the person has. There's these little things that they're just due to make each transaction different. And it's because they have a liquidity issue in place. They get to charge a $25 to $40 fee to unload loans back and forth between servicers. So there's an inefficiency there, but MCT has a real history of helping to standardize that kind of a transaction to make it seamless between different organizations. So that's certainly a place where we're going to spend some time and look at this year, as well as the GSEs. The GSEs are on that too. We understand that the subservicers would drag their feet in this particular area. So, but anyway, that'll be something that we'll end up doing more with. The other thing that we'll end up doing more with is really this whole idea of coming up with a live MSR value. Because we've obviously in the last several months experienced how interest rates have gone up and down, and certainly continuously heading up. And so what the issue has been is, how do I get the right MSR value into my pricing now? And there's really not been very many tools to do that. So we've got some good ideas around how to help accomplish that particular goal, and look forward at trying to bring those to the market here very shortly. So that should be a few of the future trends that we see on the MSR side. I think that works. Let me see. Hey, there we go. All right, good. So as far as the bulk MSR sales going on right now, we do expect definitely some exponential growth this year, really because of the environment that we're in. I mean, we spoke about this a little bit earlier, but the lower production, lower margins, lower revenue, all mortgage bankers are based on cash flow. What's the cash flow situation and how is that working? And so that is really going to, besides that, and then of course we have a rising interest rate environment, you're looking at portfolios values increasing. So you're really looking at these two different factors crossing each other and really creating a real opportunity. I mean, in the marketplace, we saw probably some of the best market in Q4 and Q1 But as we're going into Q2, we just got pricing today off live deals, and they're hitting the fives very solidly. So, and there's plenty of buyers, even on smaller deals, which you normally don't see. So the buyers are still there. They're very aggressive. They're sitting on the sidelines because they believe in this interest rate environment going up. So, and then of course the other issue that's out there that's driving a lot of folks' decision is the tax side. So certainly the short-term versus long-term tax consequences of a portfolio are big. I mean, short-term, their tax is like 39%, and then long-term it's like 20%. So it's a very big issue to look at when you're putting your packages out into the marketplace. And then in terms of key drivers of what's valuable for your book, I know when we have conversations with folks, this is not always intuitive at all. We have conversations and people think they understand the right loan to pick and which one's most valuable and those types of things. But typically, like, if you have a high loan balance and a high FICO score, that sounds like a good loan, but that's a prime candidate for a refinance and somebody moving that loan away. So, so our model takes into account really all the key factors around what drives value for loans and for the overall MSR value. So let's go for the next one here. Yeah, and in terms, so what we've noticed kind of through this process, we've become a real resource for people who had never had a portfolio before. So let me just quick raise of hands. How many of you in the last 2 years have gotten your servicing ticket? In the last 2 years? Yeah, there's a number of people. And really, it's a call we've had with Freddie and a call we've had with others, which talks about, you really need to keep your options open, and an option to be able to sell direct to the GSEs and to retain. We obviously saw how critical that is to people's futures. So with that in mind, we've helped folks quite a bit on that road, how to get there. So, we've helped them with, first of all, starting out with what their strategy is. And we actually talk about this quite often with our clients, which is what's the purpose of your portfolio? Why are you holding on to it? Is it to help really kind of give you a base to pay your expenses? Is it really for retention purposes? Is it really what you're selling to loan officers? What's your real purpose with that? And we see a lot of different types of strategies, but we encourage our clients to find out what it is that's really driving them to hold on to their particular portfolio. And then we've also been a backstop for support on how to get started. So we obviously work heavily with consultants who help people get their Freddie or Fannie or Ginnie tickets. We also help on the subservicing side. We provide that kind of background quite often. I was just having a conversation with that a little earlier today. So we have exposures to all the subservicers, and so certainly have been able to provide some meaningful insight into folks and really can kind of help on doing quite a few services there. So if there's some questions you have about activity around your subservicer, we're certainly happy to help in that regard as well. And then, of course, we're just looking at what top drivers there are for the MSR portfolio values. The real key is prepayment speed, whatever drives a prepayment speed, and certainly your WACs are going to have that. The geographic distribution is really, really important. And there are people, very much kind of like the BAM marketplace concept, there are people looking for loans in particular places. And we're helping to make those matches. So if you have a package of loans, not your whole portfolio, but if you're interested in getting rid of a certain portion of your portfolio, there are people looking for packages to fill in. Very similar to, but not exactly like the CRA concept Justin mentioned earlier today. So, and then it says, how often do I need third-party valuations? This is really driven by your regulator, your auditors, and very often your warehouse lines. And if you've been watching Black Knight's recent literature they're putting out, they're really trying to promote more heavily to get a valuation more and more frequently. I mean, it wasn't more than a couple years ago. People would get it annually. Now, based on warehouse lines and what's happened over the last couple of years, usually it's quarterly now. And then regulators and as well as auditors want to see that as well too, because a lot of that has to do with, and this is a strategy piece that Azad will touch on, you really need to contemplate some strategy in the way that you record values onto your books. and we can help you with that part as well too. But that's a big part of what happens in that auditing process. And then obviously the key is making sure not to get an impairment, or if it's an impairment, something that you planned on and you weren't surprised by. So we can certainly help you with that kind of management as well. And then these are all kind of the things that we really help on this part of the process. And Azad's going to talk more about managing your values. So let's see. Yeah, retain, released. Obviously, this from the slide that we started off with, which is such a fundamental slide about the retained release decisions that all of you are going through and what's happening in the market, and was having some conversations with folks that talking right now how strong the aggregators are paying up because they want the servicing. And so how do you make those decisions? How do you know that part as well? Well, that's the other part about having the right kind of information at your fingertips at that time of loan sale. Do you have an active value on MSR that you can compare against what your aggregator's willing to pay you? And then what are the tax implications for both of those types of sales? So those are some of the things that you need at your fingertips to really make that quality decision whether you should retain or release. And then the other retains options are really around, again, kind of around strategy. Even if there are a number of our clients who really use retaining as more like somebody called it the other day a retirement plan. So, but where they set aside 10 to 20% of whatever they can sell into their portfolio, and that builds up over time, and then it creates this natural cushion as we've talked about in terms of an offset on low origination times. But as you build that up, then you have more value in your company, and it gives you more options to work with in that regard. And then clearly, we talked about this earlier, but you have to keep track of the tax advantages about retained or released. Obviously, when you sell released, you're paying all your taxes up front, and when you're retaining, you're only paying as you gather the income through the course of the year. So, so that's where you can look for your own break-even points in terms of what's valuable to you or not, and we have tools that can give you very clear insight into that transaction, so you're not going by what's intuitive, or you're not going by because you like that originator or you like that part of the country, but you can really pick on a value number in real time, what that value is before you make the decision to sell or to retain. And then, of course, this obviously looking at different types of, your actual gains and losses and different retention strategies as well is one of the key things to look at as you look at this particular piece. One of the things that we watch is we have several clients who have developed the idea of building up their portfolio over a period of time and to a certain size, and they either consider how much expenses that they're going to cover or not from the portfolio, and then we'll aggregate enough to go sell that off as a package. And they'll do that on a regular basis. So they'll collect and then sell, collect and then sell. So there are a lot of different strategies people have out there, and then we can certainly help you kind of talk through those. So, and with that, I'm going to turn it over to Azad to talk more on the valuation and MSR management side itself, the asset.
All right. And what Dave did not mention is that we have the best donuts ever out there. If you haven't tried them, there's some with bacon that are awesome. And I wanted to just thank our friends at Lender Price for sponsoring this session and turn it over to my buddy, Azad.
Thank you, Chris. Thank you, everyone, for joining us today. Servicing, when I started back in the 80s in the servicing world, the first thought came to mind was like, what did I get myself into? But as time went by and went on, I realized this is a great asset. It's very dynamic. It's very profitable as long as it's managed properly. And over time, one of the things, when you look at the servicing asset, it's very risky, very volatile at times, as we saw the last couple of years. And so it's very, very critical that the entire business focuses on this asset. You don't leave it alone to the finance department. You don't leave it alone to the servicing department or capital market. It's all involved by everyone within the company in order to make a successful venture. With the pandemic, we all saw that as Bill mentioned, the entire industry shifted. And we saw companies that never imagined or envisioned servicing portfolio, having own servicing portfolio. They started retaining. And now, once they started retaining, they realized this is a good asset to have. And we saw several companies decided that they're going to expand their ownership of this asset. Primarily driven by profit, also was driven by availability of funds, equity funds, hedge funds, started participating with a lot of lenders and started growing those servicing portfolios. We have several companies that had zero in principal balance right before the pandemic. Now they're enjoying anywhere from $500 million to $4-6 billion in asset. And that's a significant asset to manage. So that's why I say it's very, very critical that companies get involved, all divisions, to ensure profitability for the business. There are a lot of risks and rewards at the same time. I mean, there are operational risk, financial risk, regulatory risk. All these things play a factor in the success of managing this asset. We have to look at each item alone and making sure that we comply with everything that as a servicer required and ensure the profitability of the operation. One of the things we look at servicing, it provides you this cushion or comfort level. It provides you with a steady revenue stream to keep your business afloat in times of need. Like in 2020, when originations basically and the value of servicing dropped to zero, having a servicing portfolio helped the companies maintain that business and continue with the operation. We're seeing a similar pattern right now, like especially the last couple of months when originations started dropping. And we heard from a lot of companies, including yourselves, that originations will drop roughly 20 to 40% from the 2021 levels. And that's significant to a lot of you. And in order to keep the business afloat, servicing portfolio will provide that cushion, liquidity for the business. Some companies started selling pieces of that servicing to keep the business afloat, invest in the people, invest in technology, and prepare themselves for the next phase, which we should be seeing coming along pretty quick. Other risks that come with servicing, we have like some of the things we don't think about. There are advances, to worry about. Even if you retain, you gotta be prepared to have potential escrow advances, and it's a given fact of life that you're gonna have escrow advances. It's a given fact of life that you're gonna have principal interest advances if you own MBS. So all those factors you gotta prepare for. And also you have regulatory. You gotta make sure you're in compliance. You gotta make sure if you subservice your loan, that your subservicer is abiding by those regulations, compliance, and also you have auditors. They will ask a lot of questions and making sure that your operation is in line with what is expected. Advantages, as I mentioned, is you have a steady revenue, and you can leverage your MSR, just like you leverage you have warehouse line of credit. You can leverage your MSR to finance your MSR for originating more loans, buying more MSR, funding your operation. And there's so much money out there. There's a lot of equity funds, hedge funds. They will invest in your MSR. One of the things we're seeing since going back to 2018, a lot of hedge funds and equity funds started participating in what we call excess servicing, and this is something new. We started seeing that back in 2018. What they do, they invest, like you own 25 basis point servicing strip, and they will invest in 12.5 just as an IO, and then you be responsible for the servicing. And it's very profitable, very liquid, investment, and it provides liquidity to the servicer. They could enjoy these funds, buy more loans, fund the operation, and we've seen that happen over and over. One of the things we've seen over the last 2 years, and actually ever since mortgage servicing existed, as we see valuation trends, goes up and down. I put this chart here, capitalization rates from going back like 2018 up to now. The blue line represents Freddie Mac primary 30-year mortgage rate, and then the red line is the asset or capitalization rate. So you see it kind of holds steady during 2018, 2019, and then it tanked at the beginning, with the pandemic back in March. And it was a shock to the system. And then what happened, within like a couple months, 3 months, we start seeing the aggregators getting back into the business and start buying, and they started slowly improving those MSR holdings. And that's the time when we start seeing a lot of companies who never thought about retaining started to retain loans, because they instead of selling it as 0 multiple, and we've seen such situations where companies gave up the MSR for free, just because they couldn't service it. They had no choice. And the buyers out there, they were willing to take them. Sometimes we've seen transaction hitting half a multiple for like 2 months, until the aggregators started coming back into the picture. We started seeing this improvement in pricing over time. And as mortgage rates started to bounce back a little bit, you see the MSR value started increasing. And if you look at the red line, where we are right now today, and compare it back to 2019, like at peak, when you capitalize the asset, traditionally companies were capitalizing an average of about 4.25 multiple. But now we start seeing companies in general capitalizing at an average of about 4.5 multiple. And some, companies are very conservative in their approach. So what they start doing, they say, well, I don't care what everybody else is paying. I'm going to capitalize my asset at 3 multiple, 3.5 multiple, just to be conservative. And also it allows them not to be exposed just in case mortgage rates start dropping again. And it gives them some cushion or for the spread between the value and the book basis. That way they won't be impaired at any given time. But now we're heading into a higher rate environment. And with that comes risk, because the asset itself, when you originate a loan at a 4%, it behaves differently from a loan that was originated at 3% a year ago. There is more downside impact on a 4% loan than a 3% loan. So that's why you have to be very cautious about that. And a lot of companies and say, well, let me book it at this level, but then at the same time, you have to take into consideration potential downside. And it actually happened just 2 weeks ago. 2 weeks ago, we were at about 4% interest rate based on Freddie Mac rate. But look at today. Today actually is 3.76. So there's about 12.5 basis point drop in mortgage rate, and that could impact that asset you booked 2 weeks ago. You probably lost by now 5 basis points to 6 basis points from 2 weeks ago. So those are the things you gotta be cautious about and thinking about when you originate a loan in the current market, and making sure you do not, advertently expose the asset to that down risk. There's a lot of talk, fair value, market value. Traditionally, if you look over the years, even prior to 2018, fair values tend to be in line, they move in parallel with the market value. However, it could be under fair value, but it could go up higher than the fair value but always been within 5 basis points. That's the general rule or the general average. However, when we experienced 2020, that dynamic changed significantly. And as we ended 2020, we started seeing some alignment in the fair value and the market value over time. But then we started seeing a divergence. Once we hit May of 2021, we saw a huge divergence from the fair value to the market value. Back in, prior to the pandemic, as I mentioned, it was like within 5 basis points. But now we're seeing about 12 basis points, about half a multiple divergent. But the thing is, we should not be tempted to chase that market value, because that market value, when you look at the bulk trading right now that we are experiencing today, prior to the pandemic, on average, you're lucky if you get 2 to 4 participants in a bulk trade. But right now we're seeing 8 to 12 potential buyers for that asset. But if you dissect the value or the offering by the majority of the bidders, you'll see their prices are within the fair value, within 5 basis point value. However, you'll have 1 or 2 companies that will overbid, that fair value by 12 basis points. That's why we're ending to the level of 5 to 1 and instead of 4.5 to 1. And also when you talk to the buyers, you'll hear a lot of them from capital market folks. They'll say they will never pay 5 multiple. I mean, the average is 4.5. They say if it goes 4.5 and beyond that, I'm not jumping in. I'm not going to pay 5 multiple. So that's really what drives that fair value. It's what the majority of the companies are willing to pay for that asset. The market value is driven by, a handful of players, and for a seller, it's great. Let them pay that price. But for a buyer, they want to be thoughtful about what they're paying because they don't want to have a risk associated with the asset. They don't want to overpay because rates could go down again or other economic situations that could drive that value down. So they want to give themselves some leverage or cushion, and to ensure the success of their operation. When you own an MSR asset, accounting makes a huge difference in how you capitalize the asset and what accounting method you use. There are 2 methods. One of them is the low-com, which is the lower cost or market value, and the other one is the fair value asset. The low-com method is used by, I've seen banks, independents, credit unions use the low-com method because to them, it's a very conservative approach, and they could book the asset itself at a lower level than the fair value. And it gives them that cushion and protection that they seek. And a lot of especially like credit unions, they want to be risk averse. They want to be, thoughtful about what could this do to them and their operations. So they'd rather book it at lower multiple, like current level right now, 4.5. They'd rather book it at 4 multiple just to give them about 12 basis point, cushion that they could deal with just in case rates go down as well. But on the fair value side, it's very volatile. If you book the asset at the fair value, it's going to give exposure to the P&L and balance sheet. Yes, it will increase your balance sheet in good times when rates move up. Your balance sheet will go up. Your P&L will improve. You have more profitability flowing through that P&L. But the low-com is a constant decline for the balance sheet. That's because you're amortizing the asset and it's going to continue to decline. So it makes sense to continue to add loans as you grow to increase that balance sheet. At the same time, when you capture the amortization expense, a lot of companies know it's a very predictable number. They know what to expect from year to year, month to month, what they're going to amortize, and they know exactly how it's going to impact their P&L. On the fair value side,
you're susceptible to what happens in the market, what happens to the mortgage rate. Right now, most likely, and it looks like we're going to be heading into a higher rate environment. So if you own MSR, so your P&L for the year and hopefully next year will be very good because you're going to show these profit from the MSR value gain. So that's going to continue. Financial reporting risk. We have to make sure as a servicer, as I mentioned earlier, we have to get involved as a servicer from different departments: capital markets, servicing, administration, finance. We have to make sure our reports, all the information that are available to us, are collected, accurately presented, and make sure the underlying numbers that we present are accurate to ensure the profitability of the business. And believe me when I tell you, even the slightest expense that a company incur must be, validated, must be tracked to make sure that no abnormal expenses, occur down the road. That's why it's critical to have a data warehouse. One of the things, the challenges that servicers have, actually a lot of companies do, they have different silos of information. You have one silo for servicing, one silo for accounting and finance, another silo for capital market. So it's fragmented. It makes sense to consolidate that information into one data warehouse so you could manage the asset better. You could see the flow of information, financial information, accounting information through that system, and you could compare to what's happening in the servicing world and ensure, the validity, the profitability of the business. There's a lot of tools that are available, simple, very simple. I mean, if you look at the servicing asset and the system that drive that asset, if you look at the servicing system, each system has more than 10,000 data points. I mean, when you think about it, that's like a sea of information. And it's very, very difficult to manage. But your subservicer provides you with the necessary information, and normally they provide 100 to 250 data points that are critical to the business. So when you take this 250 data points and merge it with your accounting data points, you will have wealth of information that you could manage the asset properly. And you could create simple KPI, key performance indicators. I mean, some of those indicators, you could measure how many loans are being serviced by a full-time employee. That dictates the efficiency of your business. If you're managing, if each employee within the servicing group has 500 loans, you could easily push that up to 800 loans per full-time employee. That's one metric to measure efficiency. Then you look at other KPIs. I mean, look at the advances per loan. Advances, like escrow advances, P&I advances. You could measure all those just to make sure you're aware of what's going on within the company. I had one client call me up at one point in time. They were growing significantly and very fast. And they were troubled by the fact that they were seeing a lot of escrow advances. Like, it was literally going up about $100,000 a month. And they said, this is too much for us. I mean, within a year, they ended up advancing on their books about $1 million. And that's too much money to set aside until they collect it. Because you advance that money, but not all borrowers will pay you back immediately because they're going to pay you back in installments. So it'll take a year to get that money back. So it's very, very critical we make sure we know what's going on. So when you dig into the data, you can find out a lot of information. I mean, in this particular case, we were able to identify a particular branch within a state most of those advances were coming from. And the reason we found out, it wasn't because somebody wanted to do that. It just did not have the right T&I information that they should assign to the loan. So they immediately went in and fixed this situation. And within a year, literally, we started seeing their escrow advances decline. So those are the things you need to be on top of, and making sure anything that looks odd and abnormal, you tackle it right away and zero in what is happening. And those key metrics, that's what drives it.
So Azad, I'm hearing that you measure everything like the amount of time you have left, which is down to 3 minutes, sir.
Oh, okay, sorry.
No, actually,
I'm
Azad
done.
only has 1 minute left because David is finishing up.
You have 1 minute now, sorry.
Sorry, I'll make it work. MSR liquidity. One of the things about MSR liquidity is MSR is considered an illiquid asset. And the reason for that, we do not have like a secondary market liquidity, is very efficient. MSR, ever since I started working in servicing, bulk trades, kosher trades are basically done in the same fashion through brokers, people calling each other, trying to find out if there is a bulk deal up for sale. They call potential buyers, and that's why you see 5, 10 potential buyers. But if we could create a system, a platform where buyers and sellers can meet, that will provide the liquidity both sellers and buyers are looking for. And this way, you'll have transparency in pricing, and you'll have better execution price for those deals. With that, I thank you so much. Sorry.
All right.
Is that enough, Chris?
Bring us home, David.
Good job, good job.
We can always count on Chris to take care. And that's the same way he takes care of all of you. So it's just like that. Thank you, sir. So to wrap up real quickly, I guess a couple of things. First of all, I can't tell you, MSR is the most exciting place to be right now, and I'm thrilled to be here. So it's an exciting opportunity in the marketplace. But a couple of, if you want your 3 points in a prayer to kind of walk away from with here, the first thing is I would encourage each one of you to look at how you're handling MSR values into your pricing. And there's certainly something we can do to help you do that more sharply than you are today. And that's probably where you might be leaving a little something on the table. The second thing is if you're in the mood to sell, now is the time. We still have a very active market. We just got responses back. We have active deals out that we're getting responses back today, and another one within a few days, and we've had very active buyer participation in all of those bids. There's more buyers, and they're anxious to buy. And then also, I would encourage you to spend a minute with your team to really decide and look into what is your strategy around building your portfolio. How do you want to use it? What kind of asset would you want it to be for your company? What role do you want it to play? And then the last thing I would say is a lot of folks are really starting to understand it's more complicated than they planned on, and we actually can really fill an advisory role, and there's people that has asked us to kind of run their portfolio for them. So if you ever get that far down the road, we're certainly willing to do that. And we wanted to give you one look at a tool that could sit on your desk that could really help you accomplish not only valuations in minutes, but also cash flows, also rate shock, and you can have it all on your desktop. And it's called MSR Live. I know we've talked about that, but we've got about a minute videotape we'd like to show you real quickly. So if you could pop that on for us. It's about a minute, Chris.
If it's an actual videotape, we're in trouble. I think they're working on the VHS right now.
Mortgage bankers, credit unions, and regional banks. To maintain client success during variable market conditions, MCT's MSR division is providing its clients with a wide array of tools to address current and future challenges with confidence. Let's take a look at how MCT's MSR division is helping clients of every size achieve their goals. MCT's MSR Services division is known for collaborating with clients to identify their needs based on market conditions. For example, as the pandemic-induced volatility dominated the market in early 2020, MSR clients leveraged MCT's Enhanced Best Execution Tool, or EBX, to strategically determine which loans to retain. Clients continue using this tool to ensure their retained release strategy is optimized. For those who are interested in better understanding how changing market conditions are affecting their portfolio, Our MSR Services team offers comprehensive monthly, quarterly, and annual portfolio valuations sent via PDF summary. If you have a strategy that calls for periodic bulk MSR sales, once you've grown your portfolio using these tools, the next step is to evaluate its value and whether a strategic sale is appropriate. The MSR team of experts can help analyze bids, review contracts, and find buyers for your bulk package. This service is especially vital when portfolio managers want to sell portions of their MSR asset. If you've decided to retain some or all of your production, you need to analyze and measure the risk of market and credit events on your MSR portfolio. And there's no better tool in the market today to perform this than MSR Live. MSR Live is MCT's flagship platform that allows clients to dynamically monitor their portfolio and test unlimited market scenarios. Some of the key features of MSR Live are escrow balances broken out by state for accurate reporting, detailed foreclosure costs calculated by state and loan type, comprehensive cash flows projected out over 30 years, late fees that include current but late projections, ability for limitless customer-driven assumption inputs. MSR Services can develop an MSR hedging program that's right for you. Hedge analysis and recommendations will take into account production, recapture, and other balance sheet issues related to managing the asset. MCT's approach to assisting could be as simple as providing analysis all the way up to assistance with trade execution, all depending on the client's preferences. Our modeling examines multiple factors driving MSR value, with different interactive shock analysis, basis risk, and confidence intervals with worst-case to best-case scenarios. Customer service is the key to MSR client success. Brett Hively, SVP of Mortgage and Finance at Ameris Bank, says, having MCT as part of the underpinning for our risk management and MSR asset valuation and management has been critical to navigating a challenging rate market. Whether you're getting approvals to retain your first loan or you're managing a portfolio of $100 billion, MCT's MSR Services team has the right tool to help achieve your goals. Contact us today to learn how MCT can help with your MSR strategy.